MIGAs, bonds, or CDs? What's better? Hello, members, super savers, and bond course fans. I hope you're healthy and well. Let's celebrate Annuity Awareness Month this June together. Annuity rates are at some of the highest levels that we've seen in recent years, and it's looking like they might stay at or close to those levels at least for a bit longer, with the Fed's latest decision to hold rates steady at between 4.25% and 4.5%. So if you're wondering whether now's the time to pick up an annuity for your personal portfolio, you're not alone. With that in mind, here are the 3 topics that we'll be covering in today's video. 1. What is a MIGA and how does a MIGA work? 2. Are MIGAs considered fixed income within a portfolio? And 3. How is a MIGA different from a CD and a bond? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks, to part 1 of our 2-part MIGA series this month. What is a MIGA and how does a MIGA work? A MIGA is a multi-year guaranteed annuity, a type of fixed annuity that is offered by insurance companies. The industry defines a MIGA as a fixed deferred annuity, and it works in 3 steps. First, you pay a lump sum premium to the insurance company at the beginning of the contract. Second, the amount you paid into the annuity earns a guaranteed fixed interest rate for the specific term of the contract, typically ranging from 2 to 10 years. That's where the multi-year and the fixed parts of the name come from. In addition, a MIGA usually comes with principal protection against market fluctuations. And third, at the end of the annuity contract or term, but not before, that's why it's also called a deferred annuity. So at the end of the annuity contract or term, you get paid out the principal plus interest. At this point, you can either withdraw the full amount in cash, renew the contract, or convert it into another annuity product, such as a single premium income annuity, or SPIA, if you want a lifetime income stream. The option to convert the lump sum payout from your MIGA into a lifetime income stream via a SPIA may be particularly attractive if you're planning for retirement, because you may be able to do the conversion tax-free. More about this later on in our next annuity videos, because next I'd like to answer a question that we often get about MIGAs in our bond community. Are MIGAs considered fixed income within a portfolio? As I just explained, MIGAs are insurance products, not fixed income securities. But like bonds, MIGAs typically offer principal protection and they earn you a fixed interest rate over their lifetime. And for these reasons, MIGAs and fixed income annuities in general are usually treated as fixed income within a portfolio. CDs are also treated as fixed income within a portfolio for the same reasons of principal protection and earning a fixed interest rate. Even though CDs are also not fixed income securities, CDs are bank deposit products at their core. But back to MIGAs for the time being. So, for example, say that you have a $1 million portfolio and you want to allocate 60% to stocks and 40% to bonds, the often quoted 60-40 portfolio in the industry. This means you would have $600,000 invested in the stock market and $400,000 invested in the bond market. If you were to now buy a $100,000 MIGA, those dollars would come out of the 40% bond allocation, meaning you would then only have $300,000 left over for your other bond investments. Now, there are some important differences that are MIGA specific, such as the fact that there are no regular interest payments, and there's not really a secondary market to sell it easily if you ever need the cash early. Those are not the only differences, though, between MIGAs, bonds, and CDs, just the ones that we are asked the most frequently about from our community, bringing us nicely to the next section of today's video. How is a MIGA different from a CD and a bond? As we often do here at Diamond NestEgg, let's use a table to better understand the main product differences. Here's how MIGAs differ from CDs and bonds. In this column, we have the key feature we're comparing. And in these columns here, we talk about how the key feature applies to MIGAs, multi-year guaranteed annuities, CDs, certificates of deposits, and bonds, fixed income securities. So let's start off first with the issuer. MYGAs are issued by insurance companies, where CDs are issued by banks and credit unions. And bonds are issued by governments, like the U.S. Treasuries that many of us hold in our portfolios, as well as agencies, municipalities, and companies. The second key feature has to do with the guarantee. In other words, how safe or not safe the product is. MYGAs are backed by the financial strength of the insurance company that issues them, as well as the state guarantee associations, which step in if the insurance company defaults. Think of these state guarantee associations like FDICs for annuities, but on an individual state level rather than at the federal level. And this is because insurance companies, unlike banks, are always regulated at the state level. State guarantee associations offer annuity protection that can range from as low as $100,000 to as high as about $500,000, depending on your state of residence. NOLGA, the National Organization of Life and Health Insurance Guarantee Associations, claims that since its creation in 1983, state guarantee associations have provided protection to more than 2.85 million policyholders, guaranteed more than $25.88 billion in coverage benefits, and paid more than $9.2 billion directly to policyholders. Drop a comment below if you want to learn more about how state guarantee associations try to protect your annuity investment, because it's not always straightforward with all the complexities of up to 50 states involved. Moving on now to the other products. As many of our Diamond NestEgg regulars know, CDs are FDIC or NCUA insured up to $250,000 per depositor per insured bank for each account ownership category. We'll come back to that later. And bonds are primarily backed by the bond issuer's credit worthiness. U.S. Treasuries, for example, are backed by the full faith and credit of the federal government. The third key feature is the term, the length of the contract. MYGAs are generally sold in terms of 2 to 10 years. CDs in terms of 3 months to 5 years. There are some CDs with terms longer than 5 years, but these are not so commonplace in the current environment. And for bonds, it varies widely, from 4 weeks to 30 years for Treasuries. Terms for other bonds vary. Up next is our fourth key feature, interest rates. For MYGAs, the interest rate is generally fixed and guaranteed for the entire term, unaffected by market volatility, and it's often higher than CDs. For CDs, the interest rate is also generally fixed and guaranteed for the entire term, but typically lower than MYGAs. Before you rush off to pick up a MIGA instead of a CD, though, let's go through the rest of our comparison table first. Remember, there are no free lunches in finance, and there are other key factors to consider. Let's keep going with the interest rate for bonds. Most of the bonds we talk about on this channel have fixed interest rates, but in real life, the interest rate on bonds can be fixed or variable, depending on the bond type, the issuer, as well as existing market conditions. The fifth key feature here is taxation, when held in a taxable account, or phrased another way, when not held in a tax-advantaged retirement account. Holding MYGAs, or any annuities for that matter, in a retirement account is a separate video on its own, so let's save that one for another day if there's enough interest. So, MYGAs offer tax-deferred growth, with interest taxed upon withdrawal as ordinary income. For CDs, interest is taxed annually as ordinary income, even if not withdrawn. For bonds, interest is taxed annually in most, but not all cases. For instance, interest earned on many types of municipal bonds are fully tax exempt when purchased by in-state residents, and interest earned on treasuries is exempt from state and local income taxes. That said, with bonds, capital gains taxes are possible if the bond is sold before maturity. The sixth key feature is liquidity. MYGAs have limited liquidity, with potentially significant surrender charges for early withdrawal, depending on the amount withdrawn and how long you've held the annuity for. That said, many annuities allow 10% penalty-free withdrawals annually after the first year. CDs also have limited liquidity, with penalties for early withdrawal. This generally means a loss of several months' interest, which in many cases translates into less severe penalties than that for annuities. For many super savers, one of the key questions when deciding between annuities and CDs, all else being equal, is whether the higher interest rate on a MIGA is worth it given the lower liquidity. because the lower liquidity is essentially the price you pay for the often higher interest rates from MIGAs. For bonds, liquidity varies. As our Diamond NestEgg regulars know, treasuries are usually highly liquid, but agencies, corporates, and munis can often be less liquid. And in all cases, the selling price is market dependent. Moving on now to the seventh key feature, and that's credit and market risk. MIGAs are usually low risk. While they depend on the insurer's financial stability, they are also backed by their state guarantee association. That said, as insurance products, MIGAs are not FDIC insured, and typically there is no market risk for MIGAs. CDs are considered very low risk due to FDIC and NCUA insurance, also typically with no market risk. With bonds, risk varies. Taking treasuries again as our example, treasuries are considered practically risk-free, while most other bonds carry credit risk. The market price of bonds also fluctuates based on interest rates, investor sentiment, economic outlook, and so on. Before we move on, I think I probably can't be clear enough about one point. If you are only comfortable with an investment that is guaranteed by the federal government, you'll need to stay with either FDIC or NCUA insured CDs, or with treasuries or agencies that are explicitly backed by the full faith and credit of the federal government. And if the U.S. were ever to default on its treasuries, it's difficult to say whether holding an FDIC or NCUA insured CD would be all that much better. And a reminder here, if you invest in either CDs or MIGAs, remember to stay within the respective state guarantee and or FDIC limits. Again, for CDs, that's a standard FDIC limit of up to $250,000 per depositor per insured bank for each account ownership category. And for MIGAs, where it's a bit more complex, it can be anywhere between $100,000 and $500,000, depending on your state of residence. So always make sure you understand how it would work in your specific case. Up next is the eighth key feature, purpose. MIGAs are primarily used for long-term savings, retirement planning, and or tax-deferred growth. With MIGAs, interest compounds without annual taxes, enhancing growth until withdrawal. CDs are typically intended for short to medium-term savings with guaranteed returns, whereas bonds are more multi-purpose in a portfolio. They can be used for short or long-term savings, retirement planning, income generation, and or portfolio diversification. MIGAs, CDs, and bonds share one common purpose, though, and that's capital preservation. You are not putting your principal at risk, assuming a hold to maturity and our standard no default scenarios. So, to summarize, what we can see from this table is that MIGAs offer tax-deferred growth, making them attractive for those planning for retirement and or in higher tax brackets. MIGAs typically offer higher yields than CDs, but may have potentially higher early withdrawal penalties. They also lack FDIC insurance, relying instead on the insurer's financial strength and state guarantee associations. CDs are FDIC insured, making them safer for the ultra-conservative investors, but their generally lower rates and annual taxation may reduce effective returns compared to MIGAs. And bonds, they vary widely in all these dimensions of issuer, guarantee, term, interest rate, taxation, liquidity, risk, and purpose. In addition, unlike MIGAs and CDs, bond prices fluctuate with interest rates, investor sentiment, economic outlook, etc., which may introduce a certain element of market risk if you don't hold your bond to maturity. So, now that you understand where MIGAs are similar and different from CDs and bonds, what is it for you? Would you consider adding MIGAs to your fixed income portfolio? Or do you already own some MIGAs? Or perhaps it's CDs and or bonds for you? Drop a comment below and let me and the community know. And in case you are interested in learning more about MIGAs, stay tuned for our next video on MIGAs, where I'll go through who should and should not consider a MIGA, as well as some key considerations to keep in mind when purchasing a MIGA. As I always say, everyone's financial journey is different. Just as there's no one right answer for everyone when selecting bonds for a portfolio, there is no one right answer for everyone when it comes to selecting a MIGA, or annuities in general for that matter. The key is selecting one that's aligned with your financial goals, time horizon, risk tolerance, and tax situation. Speak to your financial advisor or email us at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist. And come join our live member Q&A this month, happening today at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into all things annuities and fixed income, including the upcoming 2, 5, and 7-year T-note auctions. All right, members, super savers, and bond course fans, once again, happy Annuity Awareness Month. I hope you enjoyed today's video and learned something new. I've also linked all the details on our other annuity videos, bond courses, and YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.